Question 1. Cost-benefit analysis shows that a proposed partnership for Dole PLC could significantly increase market share and profitability, but the potential partner has a history of questionable labor practices that may not directly violate current Dole PLC hiring assessment test guidelines, but raise ethical concerns. Which approach best aligns with Dole PLC's commitment to responsible business conduct and regulatory compliance? Option A. Proceed with the partnership after a thorough review to ensure no direct violations of Dole PLC hiring assessment test guidelines are present, focusing on the financial benefits. Option B. Seek legal counsel to determine if the partner's practices constitute a direct violation of any applicable law, and proceed based solely on the legal opinion. Option C. Proceed with the partnership but implement internal monitoring to mitigate potential reputational risks, prioritizing the financial gains. Option D. Decline the partnership due to the ethical concerns surrounding the potential partner's labor practices, even if no direct regulatory breaches are identified. Correct answer is A. Proceed with the partnership after a thorough review to ensure no direct violations of Dole PLC hiring assessment test guidelines are present, focusing on the financial benefits. Explanation. This scenario is professionally challenging because it requires Dole PLC to balance potential financial gains against its ethical obligations and adherence to the regulatory framework governing its operations. The decision-making process must be grounded in a thorough understanding of the relevant laws and ethical principles to ensure compliance and maintain stakeholder trust. The correct approach involves prioritizing the company's commitment to ethical conduct and regulatory compliance, even if it means forgoing a potentially profitable but ethically questionable opportunity. This aligns with the principles of corporate social responsibility and good governance, which are increasingly emphasized by regulatory bodies and investors. Specifically, adhering to the Dole PLC hiring assessment test's implicit guidelines on ethical business practices and regulatory adherence means that any decision must first pass a rigorous ethical and legal review. The regulatory framework for hiring assessments, while not explicitly detailed here, universally mandates fairness, non-discrimination, and adherence to data privacy principles. Therefore, an approach that proactively identifies and mitigates ethical and regulatory risks, even if it adds initial complexity or cost, is the most sound. This demonstrates a commitment to long-term sustainability and reputation management, which are critical for a publicly traded company like Dole PLC. An incorrect approach would be to solely focus on the immediate financial benefits without adequately considering the ethical implications or potential regulatory breaches. This could lead to significant reputational damage, legal penalties, and loss of investor confidence. For instance, overlooking potential conflicts of interest or failing to conduct due diligence on the ethical standing of a partner could violate principles of integrity and probity, which are fundamental to financial markets regulation and corporate governance. Another incorrect approach might be to assume that a lack of explicit prohibition means an action is permissible. However, ethical frameworks and regulatory intent often extend beyond explicit rules to encompass broader principles of fairness and responsible conduct. Failing to consider these broader principles can result in actions that, while not directly illegal, are ethically unsound and could attract regulatory scrutiny or public backlash. Professionals at Dole PLC should employ a decision-making framework that begins with identifying all relevant stakeholders and their interests. This should be followed by a comprehensive assessment of potential ethical and regulatory risks associated with each option. A structured risk assessment, including mitigation strategies, is crucial. The decision should then be evaluated against the company's stated values, ethical code, and the applicable regulatory framework. If an option presents significant ethical or regulatory concerns, it should be rejected or modified, even if it appears financially attractive. This proactive and principled approach ensures that decisions are not only profitable, but also sustainable and defensible. Question 2. Regulatory review indicates that Dole PLC employees are frequently interacting with suppliers and business partners. In this context, what is the most appropriate course of action for a Dole PLC employee when offered a high-value gift by a supplier during a business meeting, where the gift is not cash but a branded electronic device? Option A. Accept the gift, as it is a common practice in the industry and will not influence business decisions. Option B. Accept the gift and report it to Dole PLC's compliance department immediately for valuation and guidance. Option C. Politely decline the gift and explain that Dole PLC policy prohibits accepting gifts of significant value. Option D. Accept the gift, as it is not cash and is from a known supplier, assuming it is a standard business courtesy. The correct answer is D. Accept the gift, as it is not cash and is from a known supplier, assuming it is a standard business courtesy. Explanation. This scenario is professionally challenging because it requires Dole PLC employees to navigate potential conflicts of interest and ensure compliance with internal policies and external regulations concerning the acceptance of gifts and entertainment. The core challenge lies in distinguishing between permissible business courtesies and those that could be perceived as influencing business decisions or violating ethical standards. Careful judgment is required to uphold Dole PLC's reputation and maintain trust with stakeholders. The correct approach involves a thorough understanding and application of Dole PLC's specific gift and entertainment policy, which likely aligns with broader regulatory expectations for ethical conduct in business. This approach prioritizes transparency, adherence to predefined limits, and seeking approval for items exceeding those limits. This is justified by the need to prevent bribery, corruption, and undue influence, thereby safeguarding Dole PLC's integrity and compliance with relevant anti-bribery and corruption laws, which often mandate robust internal controls and reporting mechanisms for gifts and hospitality. An incorrect approach that involves accepting a gift without considering its value or potential implications fails to recognize the inherent risks of perceived or actual impropriety. This could lead to violations of Dole PLC's internal policies and potentially breach anti-bribery legislation by creating an appearance of favoritism or quid pro quo. Another incorrect approach, accepting a gift that clearly exceeds established limits without seeking prior approval, directly contravenes policy and demonstrates a disregard for established compliance procedures, exposing Dole PLC to significant reputational and legal risks. A third incorrect approach, assuming all gifts from suppliers are acceptable as long as they are not cash, overlooks the fact that non-cash gifts can also carry significant value and create undue influence, thus failing to meet the spirit and letter of ethical guidelines. Professionals should employ a decision-making framework that begins with a clear understanding of Dole PLC's gift and entertainment policy. When faced with an offer of a gift or entertainment, they should assess its nature, value, and the context of the relationship with the giver. If there is any doubt about its appropriateness or if it exceeds defined thresholds, the professional should consult the policy, seek guidance from their manager or the compliance department, and obtain necessary approvals before acceptance. This proactive and cautious approach ensures adherence to both internal standards and external legal requirements. Question 3. Consider a scenario where Dole PLC's internal audit department has identified a significant operational issue that could potentially impact the company's financial performance in the upcoming quarter. The head of internal audit has prepared a detailed report outlining the findings and their potential implications. What is the most appropriate next step for Dole PLC to ensure compliance with UK regulatory requirements and best corporate governance practices? Option A. Conduct a thorough review of the internal audit report by Dole PLC's compliance department and legal counsel to assess its materiality and determine the appropriate disclosure strategy in accordance with FCA listing rules and the UK Corporate Governance Code. Option B. Hold the internal audit report internally and await further developments, hoping the operational issue resolves itself before it significantly impacts financial performance. Option C. Share the internal audit report exclusively with Dole PLC's largest institutional investors to inform them of the potential impact. Option D. Immediately disseminate the internal audit report to all Dole PLC shareholders to ensure full transparency. The correct answer is D. Immediately disseminate the internal audit report to all Dole PLC shareholders to ensure full transparency. Explanation. This scenario presents a professional challenge because Dole PLC, as a publicly listed company, is subject to stringent regulatory oversight and ethical expectations regarding its financial reporting and investor communications. The challenge lies in balancing the need to provide timely and accurate information to stakeholders with the imperative to comply with all applicable regulations, particularly those governing disclosure of material information. Misinterpreting or misapplying these regulations can lead to significant legal penalties, reputational damage, and loss of investor confidence. The correct approach involves Dole PLC's compliance department meticulously reviewing the internal report against the disclosure requirements of the UK Financial Conduct Authority, FCA listing rules, and the UK Corporate Governance Code. This approach is best professional practice because it prioritizes regulatory adherence and ethical transparency. The FCA listing rules mandate prompt disclosure of any information which, if omitted, might reasonably be expected to be, or is likely to be, price-sensitive. The UK Corporate Governance Code emphasizes the importance of timely and balanced disclosure of all material information. By conducting a thorough review, Dole PLC ensures it meets these obligations, safeguarding its integrity and investor trust. An incorrect approach would be to immediately release the information without a formal compliance review. This fails to adhere to the FCA listing rules, which require a careful assessment of whether the information is price-sensitive and needs to be disclosed. It also risks violating the UK Corporate Governance Code's principle of balanced disclosure, potentially leading to market speculation or misinterpretation. Another incorrect approach would be to delay disclosure indefinitely, hoping the issue resolves itself. This contravenes the FCA's requirement for prompt disclosure of price-sensitive information and undermines the UK Corporate Governance Code's emphasis on transparency and accountability. Such a delay could be interpreted as an attempt to mislead the market. A further incorrect approach would be to disclose the information only to a select group of major shareholders. This would violate the principle of equal access to information for all investors, a cornerstone of fair markets, and a breach of the FCA's market abuse regulations, which prohibit selective disclosure of inside information. Professionals should employ a decision-making framework that prioritizes a systematic review process. This involves 1. Identifying the nature of the information and its potential impact on Dole PLC's share price. 2. Consulting relevant regulatory frameworks, e.g., FCA listing rules, UK Corporate Governance Code. 3. Seeking expert advice from legal and compliance teams. 4. Determining the appropriate disclosure mechanism and timing based on regulatory requirements and best ethical practices. This structured approach ensures that decisions are informed, compliant, and uphold the highest standards of corporate governance. Question 4. The risk matrix shows significant high-risk ratings associated with revenue recognition and inventory valuation processes at Dole PLC. Which of the following represents the most appropriate initial response for Dole PLC's management? Option A. Immediately initiate a comprehensive, independent investigation involving internal audit and potentially external forensic accountants to thoroughly examine the identified high-risk areas, determine the root causes of discrepancies, and assess compliance with applicable accounting standards. Option B. Instruct the accounting department to make minor adjustments to the current financial statements to reduce the risk ratings without a detailed underlying investigation. Option C. Publicly state that the risk matrix is a preliminary tool and its findings are not definitive, thereby downplaying the significance of the identified high-risk areas. Option D. Defer any action until the next scheduled external audit, assuming the external auditors will identify and rectify any issues. The correct answer is A. Immediately initiate a comprehensive, independent investigation involving internal audit and potentially external forensic accountants to thoroughly examine the identified high-risk areas, determine the root causes of discrepancies, and assess compliance with applicable accounting standards. Explanation. This scenario is professionally challenging because Dole PLC, as a publicly listed company, operates under strict regulatory scrutiny. The risk matrix highlights potential breaches of financial reporting standards, which, if not addressed appropriately, could lead to significant legal penalties, reputational damage, and loss of investor confidence. The core challenge lies in balancing the need for accurate and timely financial disclosure with the potential for internal pressures to present a more favorable, albeit misleading, financial picture. Careful judgment is required to ensure compliance with all applicable regulations and ethical standards. The correct approach involves a thorough, independent investigation into the identified discrepancies. This means engaging qualified internal audit personnel or external forensic accountants to meticulously examine the transactions and accounting treatments that contributed to the high-risk ratings. The objective is to ascertain the root cause of the discrepancies, determine if any accounting standards have been violated, and quantify the impact. This approach aligns with the principles of good corporate governance and regulatory compliance, ensuring that Dole PLC's financial statements are accurate and comply with the relevant accounting frameworks, e.g., IFRS or US GAAP, depending on Dole PLC's reporting jurisdiction. It also demonstrates a commitment to transparency and accountability, which are paramount for maintaining stakeholder trust and adhering to legal obligations. An incorrect approach would be to dismiss the risk matrix findings without proper investigation, perhaps due to time constraints or a desire to avoid negative publicity. This failure to investigate constitutes a dereliction of duty and a potential violation of regulatory requirements that mandate accurate financial reporting. It also ignores the ethical obligation to stakeholders to provide truthful financial information. Another incorrect approach would be to conduct a superficial review that only addresses the symptoms rather than the underlying causes of the discrepancies. This might involve making minor adjustments without understanding the systemic issues that led to the high-risk ratings. Such an approach would not provide assurance that future reporting will be accurate and could still leave Dole PLC vulnerable to regulatory action and reputational damage. It fails to meet the standard of due diligence expected of a responsible corporate entity. A third incorrect approach would be to attempt to manipulate accounting entries to bring the risk ratings down without a genuine basis in accounting principles. This is not only unethical, but also constitutes fraudulent financial reporting, which carries severe legal consequences. It undermines the integrity of financial markets and erodes public trust. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and document all identified risks and concerns, such as those presented by the risk matrix. 2. Initiate a prompt and thorough investigation, utilizing appropriate expertise, internal audit, external specialists. 3. Objectively assess findings against relevant regulatory frameworks and accounting standards. 4. Quantify any identified misstatements or non-compliance. 5. Develop and implement corrective actions to address root causes and prevent recurrence. 6. Ensure appropriate disclosure to stakeholders and regulatory bodies as required. 7. Maintain a culture of ethical conduct and robust internal controls. Question 5. The investigation demonstrates that Dole PLC is experiencing significant operational disruption due to unforeseen supply chain issues, which are projected to negatively impact its upcoming quarterly earnings. The investor relations team is considering how best to communicate this development to the market. Which of the following approaches best adheres to regulatory frameworks and ethical best practices for Dole PLC? Option A. Highlight recent positive operational achievements and downplay the significance of the supply chain disruptions in any public statements. Option B. Issue a general statement acknowledging potential market headwinds without specifying the nature or severity of the supply chain problems. Option C. Proactively disclose the supply chain challenges and their potential impact on earnings, along with the steps Dole PLC is taking to mitigate these issues. Option D. Delay the disclosure of the supply chain issues until the full extent of the impact is quantifiable and the next earnings report is due. The correct answer is C. Proactively disclose the supply chain challenges and their potential impact on earnings, along with the steps Dole PLC is taking to mitigate these issues. Explanation. This scenario presents a professional challenge because Dole PLC, as a publicly listed company, operates under strict regulatory scrutiny. The need to balance investor relations with accurate financial reporting is paramount. Misrepresenting financial information, even with the intention of managing market perception, can lead to severe legal and reputational consequences. Careful judgment is required to ensure all disclosures are truthful, complete, and not misleading, adhering to the principles of transparency and fairness expected by regulators and stakeholders. The correct approach involves proactively communicating the challenges faced by Dole PLC and their potential impact on financial performance, while also outlining the mitigation strategies being implemented. This demonstrates a commitment to transparency and allows investors to make informed decisions based on a realistic assessment of the company's situation. This aligns with regulatory requirements for timely and accurate disclosure of material information, preventing market manipulation and fostering investor confidence. Ethically, it upholds the duty of care owed to shareholders and the broader market. An incorrect approach that involves delaying the disclosure of negative information until it is unavoidable or presenting it in a way that downplays its significance, constitutes a failure to meet regulatory obligations for timely disclosure. This can be interpreted as an attempt to mislead the market, potentially violating securities laws and leading to investigations and penalties. Ethically, it breaches the trust placed in the company by its investors. Another incorrect approach, which is to selectively disclose positive information while omitting or minimizing negative aspects, is also a serious regulatory and ethical failure. This creates an incomplete and therefore misleading picture of Dole PLC's financial health, which can lead to misinformed investment decisions and market distortion. A further incorrect approach, which is to provide vague or overly optimistic projections without a clear basis, fails to meet the standard of providing accurate and reliable information. This can be seen as an attempt to artificially inflate share prices or manage expectations without substance, which is a violation of disclosure principles. Professionals in such situations should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Identifying all material information that could affect Dole PLC's financial performance and investor perception. 2. Consulting with legal and compliance teams to ensure all disclosures meet regulatory standards. 3. Developing clear, concise, and truthful communication strategies that address both challenges and mitigation efforts. 4. Ensuring that all communications are disseminated in a timely and equitable manner to all stakeholders. Question 6. The analysis reveals that a financial advisor at Dole PLC is tasked with recommending investment products to a new client. The client has expressed a moderate risk tolerance and a desire for capital growth over a medium-term horizon. However, Dole PLC currently has a strong inventory of a particular high-yield bond fund that is performing well but carries a higher risk profile than the client's stated tolerance. The advisor is under pressure to meet quarterly sales targets. Which of the following approaches best adheres to regulatory requirements and professional ethics for Dole PLC? Option A. Recommend the high-yield bond fund, emphasizing its recent strong performance and the potential for higher returns, while disclosing its higher risk profile. Option B. Prioritize meeting the quarterly sales target by recommending the high-yield bond fund, assuming the client will understand the risks associated with higher returns. Option C. Conduct a comprehensive assessment of the client's financial situation, investment objectives, and risk tolerance, and recommend products that are demonstrably suitable, even if they are not the high-yield bond fund. Option D. Recommend a diversified portfolio of products that includes the high-yield bond fund, but only after ensuring the client fully understands the specific risks of each component. The correct answer is C. Conduct a comprehensive assessment of the client's financial situation, investment objectives, and risk tolerance, and recommend products that are demonstrably suitable, even if they are not the high-yield bond fund. Explanation. This scenario presents a professional challenge because it requires an individual at Dole PLC to interpret and apply regulatory requirements concerning client suitability and disclosure in a way that balances business objectives with client protection. The core difficulty lies in ensuring that recommendations made to clients are genuinely aligned with their stated needs and risk tolerance, rather than being influenced by internal sales targets or product availability. This requires a nuanced understanding of both the client's circumstances and the regulatory obligations. The correct approach involves a thorough and documented assessment of the client's financial situation, investment objectives, and risk tolerance before making any product recommendations. This proactive due diligence ensures that any proposed investment is suitable for the client, thereby adhering to the principles of client protection and fair dealing mandated by regulatory frameworks. Specifically, this aligns with the duty to act in the client's best interests, which is a cornerstone of financial regulation. By prioritizing the client's needs and conducting a comprehensive suitability assessment, the individual upholds ethical standards and regulatory compliance, minimizing the risk of mis-selling and potential regulatory action against Dole PLC. An incorrect approach that prioritizes immediate sales targets over client suitability would be a significant regulatory and ethical failure. This would breach the duty to act in the client's best interests and could be construed as mis-selling, leading to severe consequences including fines, reputational damage, and client remediation. Another incorrect approach, which involves making recommendations based on readily available products without a proper assessment of client needs, also fails to meet the suitability requirements. This demonstrates a lack of diligence and a disregard for the client's specific circumstances, again contravening regulatory expectations. Finally, an approach that relies on generic disclosures without ensuring the client truly understands the risks and suitability of the recommended product is also flawed. Effective disclosure requires more than just providing information. It necessitates ensuring comprehension and relevance to the individual client. Professionals should employ a decision-making framework that begins with a clear understanding of their regulatory obligations and ethical duties. This involves prioritizing client interests above all else, conducting thorough due diligence, documenting all assessments and recommendations, and seeking clarification when in doubt. The process should involve a systematic evaluation of client information against regulatory suitability standards, ensuring that any recommendation is demonstrably in the client's best interest and appropriately disclosed. Question 7. Compliance review shows that a candidate for a senior role at Dole PLC has indicated they possess detailed knowledge of Dole PLC's upcoming strategic initiatives, which have not yet been publicly announced. To assess the validity of this claim and the candidate's suitability, what is the most appropriate and compliant method for the hiring manager to gather further information regarding these initiatives? Option A. Directly contact a known acquaintance working in Dole PLC's operational department to inquire about the candidate's mentioned initiatives. Option B. Request Dole PLC's Investor Relations Department to provide a briefing on any non-public strategic initiatives relevant to the candidate's role. Option C. Ask the candidate to provide specific details of these initiatives through informal communication channels, such as a private message on a professional networking site. Option D. Search for information about Dole PLC's strategic plans on unofficial industry forums and social media groups to corroborate the candidate's claims. The correct answer is B. Request Dole PLC's Investor Relations Department to provide a briefing on any non-public strategic initiatives relevant to the candidate's role. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to expand its market reach and the stringent regulatory requirements designed to protect investors and market integrity. The need for Dole PLC to comply with the specific hiring assessment tests regulatory framework, which is assumed to be based on UK regulations and SISI guidelines for this exam, requires a nuanced understanding of how to gather information without inadvertently breaching confidentiality or market abuse rules. Careful judgment is required to balance business objectives with legal and ethical obligations. The correct approach involves seeking information through publicly available channels or direct, authorized disclosures from Dole PLC's Investor Relations or Legal Department. This method upholds regulatory compliance by ensuring that any information obtained is either already in the public domain or is being shared through official, transparent channels. Specifically, under UK regulations and SISI guidelines, the prohibition against insider dealing and the requirement for fair disclosure of material information are paramount. Accessing information through authorized channels ensures that Dole PLC is not inadvertently disclosing non-public, price-sensitive information to a potential candidate in a manner that could be construed as market abuse. This approach prioritizes integrity and adherence to the spirit and letter of the law. An incorrect approach that involves attempting to obtain information from a current Dole PLC employee outside of official channels, such as through informal social media conversations or direct, unauthorized inquiries to operational staff, represents a significant regulatory and ethical failure. This could lead to the unintentional disclosure of inside information, potentially violating rules against market abuse and insider dealing. Furthermore, it demonstrates a lack of due diligence and respect for Dole PLC's internal compliance procedures and the confidentiality obligations of its employees. Another incorrect approach, such as relying solely on speculative news articles or unverified online forums, fails to meet the standard of due diligence required for a hiring assessment. Such sources are often unreliable and may contain inaccurate or misleading information, which could lead to flawed decision-making and a misrepresentation of Dole PLC's actual situation. This approach also risks relying on information that may not be considered public in a regulatory sense, especially if it pertains to non-public strategic plans or financial performance. A professional decision-making process for similar situations should involve a clear understanding of the regulatory environment, particularly concerning market abuse, insider dealing, and data privacy. When faced with a need for information, professionals should first identify what information is genuinely required and then determine the most appropriate and compliant method for obtaining it. This typically involves consulting official company communications, regulatory filings, or designated points of contact within the organization. If direct access to non-public information is necessary, it should only be pursued through formal, authorized processes that ensure compliance with all relevant laws and ethical guidelines. A risk-based assessment should always be conducted to identify potential compliance breaches before any action is taken. Question 8. To address the challenge of a colleague from another department at Dole PLC requesting access to sensitive client financial data for what they describe as an urgent internal review, what is the most appropriate course of action to ensure compliance with data protection regulations and maintain client confidentiality? Option A. Share the requested data with the colleague based on their verbal assurance that the request is for an urgent internal review and that they are a trusted member of Dole PLC. Option B. Forward the request to the client's primary account manager for them to decide whether to grant access to the colleague. Option C. Strictly follow Dole PLC's established data handling protocols, which require explicit written authorization from the client before any sensitive information can be shared, and inform the colleague of this requirement. Option D. Politely decline the request, stating that internal reviews do not warrant access to client data, without further investigation or seeking clarification. The correct answer is C. Strictly follow Dole PLC's established data handling protocols, which require explicit written authorization from the client before any sensitive information can be shared, and inform the colleague of this requirement. Explanation. Scenario analysis. This scenario presents a professional challenge for a Dole PLC employee tasked with handling sensitive client information. The challenge lies in balancing the need to provide efficient service with the absolute imperative of safeguarding confidential data against unauthorized access or disclosure. The potential for reputational damage, regulatory penalties, and loss of client trust makes careful judgment and adherence to strict protocols paramount. The employee must navigate the internal policies of Dole PLC, which are themselves designed to comply with relevant regulatory frameworks to ensure data integrity. Correct approach analysis. The correct approach involves strictly adhering to Dole PLC's established data handling protocols and seeking explicit authorization from the client before sharing any information, even with internal departments. This aligns with the fundamental principles of data privacy and client confidentiality, which are typically enshrined in regulatory frameworks governing financial services and data protection. Specifically, this approach upholds the duty of care owed to clients and ensures compliance with regulations that mandate secure data handling and require explicit consent for information sharing. By verifying the legitimacy of the request and obtaining client approval, the employee acts as a responsible custodian of sensitive information, mitigating risks of breaches and unauthorized disclosure. Correct approach is analysis, an approach that involves sharing the information based on a verbal assurance from an internal colleague, without verifying the request's legitimacy or obtaining client consent, represents a significant regulatory and ethical failure. This bypasses established security protocols and creates a direct pathway for potential data misuse or unauthorized access, violating principles of data protection and client confidentiality. Such an action could lead to breaches of data privacy laws, resulting in substantial fines and reputational damage for Dole PLC. Another incorrect approach would be to dismiss the request outright without proper investigation or escalation. A caution is necessary. A complete refusal without understanding the context or exploring legitimate internal needs could hinder operational efficiency and potentially alienate internal stakeholders. However, the primary failure here is not in the refusal itself, but in the lack of a structured process to assess and respond to such requests, which could still lead to compliance issues if not handled appropriately through authorized channels. A third incorrect approach, which is to assume the request is legitimate due to the internal nature of the requester and proceed with sharing the data, is also a critical failure. This demonstrates a lack of diligence and an over-reliance on internal relationships rather than established procedures. It ignores the principle that all data sharing, regardless of the requester's position, must be authorized and compliant with data protection policies. This can lead to inadvertent breaches and a breakdown of the firm's security posture. Professional reasoning. Professionals in this situation should employ a risk-based decision-making framework. This involves 1. Identifying the sensitive nature of the information and the potential risks associated with its disclosure. 2. Consulting and strictly adhering to Dole PLC's internal policies and procedures for data handling and client information sharing. 3. Verifying the legitimacy and necessity of any request for information, particularly from internal sources. 4. Prioritizing client consent and explicit authorization before any data is shared. 5. Escalating any ambiguous or high-risk requests to a supervisor or designated compliance officer for guidance. This structured approach ensures that decisions are not based on assumptions or convenience, but on a robust framework of regulatory compliance and ethical responsibility. Question 9. The review process indicates that a senior manager at Dole PLC has become aware of a significant, non-public development regarding a potential acquisition target that could substantially impact Dole PLC's stock price upon public announcement. The manager is considering purchasing shares in the acquisition target before the news is released. Which of the following represents the most appropriate and compliant course of action for the senior manager? Option A. Immediately purchase shares in the acquisition target, as this is a legitimate investment opportunity based on proprietary research. Option B. Share the information with a trusted friend who is an experienced investor, advising them to consider investing in the acquisition target. Option C. Proceed with the purchase of shares in the acquisition target, assuming that the information is not yet considered insider information until officially announced. Option D. Refrain from trading in the acquisition, target shares and consult with Dole PLC's legal and compliance departments regarding the information and potential trading restrictions. The correct answer is A. Immediately purchase shares in the acquisition target, as this is a legitimate investment opportunity based on proprietary research. Explanation. This scenario presents a professional challenge because it requires an individual at Dole PLC to navigate potential conflicts of interest and ensure compliance with internal policies and external regulations, specifically concerning the disclosure of material non-public information. The pressure to act quickly on a potential investment opportunity, coupled with the knowledge of sensitive company information, necessitates a rigorous adherence to ethical and legal standards. Careful judgment is required to distinguish between legitimate business activities and insider trading. The correct approach involves prioritizing compliance and ethical conduct over personal gain. This means refraining from trading on the information until it is publicly disclosed and seeking guidance from the appropriate internal compliance or legal department. This approach aligns with the principles of fair markets and regulatory integrity, preventing any perception or reality of unfair advantage derived from privileged information. Specifically, it upholds the spirit and letter of regulations designed to prevent insider trading, ensuring that all market participants have access to the same information at the same time. An incorrect approach would be to proceed with the trade without considering the implications of the non-public information. This could lead to a violation of insider trading laws, which carry severe penalties for both individuals and the company. Another incorrect approach would be to rely solely on personal judgment without consulting the company's compliance or legal teams. This bypasses established internal controls designed to mitigate risk and ensure adherence to regulatory frameworks. A third incorrect approach would be to share the information with others who might trade on it, which constitutes tipping and is also a serious regulatory offense. Professionals facing similar situations should employ a decision-making framework that prioritizes ethical considerations and regulatory compliance. This involves 1. Identifying the nature of the information. Is it material and non-public? 2. Recognizing potential conflicts of interest or regulatory implications. 3. Consulting internal policies and procedures regarding trading and information disclosure. 4. Seeking advice from the company's compliance or legal department before taking any action. 5. Documenting all communications and decisions made. This systematic approach ensures that actions are taken with full awareness of legal and ethical obligations. Question 10. What factors determine the appropriate method for Dole PLC employees to share sensitive client information internally to ensure compliance with data protection regulations and maintain client confidentiality? Option A. the general understanding of data security without specific reference to company policies or regulations. Option B, the convenience of the sharing method for the employee and the perceived urgency of the information. Option C, the sensitivity of the client information, Dole PLC's internal data handling policies, and the specific regulatory requirements applicable to the data. Option D, the ability to share information quickly via readily available communication tools, regardless of their security features. The correct answer is C, the sensitivity of the client information, Dole PLC's internal data handling policies, and the specific regulatory requirements applicable to the data. Explanation: this scenario presents a professional challenge for Dole PLC employees regarding the ethical and regulatory implications of handling sensitive client information. The core difficulty lies in balancing the need for efficient internal communication and collaboration with the strict obligations to protect client confidentiality and comply with data protection laws. Misjudging this balance can lead to severe reputational damage, legal penalties, and a breach of trust with clients. The correct approach involves a thorough understanding of Dole PLC's internal data handling policies, which are designed to align with relevant regulatory frameworks. This approach prioritizes data minimization, secure transmission methods, and access controls, ensuring that client information is only shared when strictly necessary and through approved, protected channels. This aligns with the ethical duty of care and the legal requirements of data privacy regulations, such as those governing the handling of personal and commercially sensitive data. By adhering to these protocols, Dole PLC demonstrates its commitment to client trust and regulatory compliance. An incorrect approach that involves sharing client data via unencrypted email for convenience fails to acknowledge the inherent security risks. This method is highly vulnerable to interception and unauthorized access, directly contravening data protection principles that mandate secure handling of sensitive information. Such a failure constitutes a significant regulatory breach and an ethical lapse, as it exposes client data to potential compromise. Another incorrect approach, which involves discussing client details in public spaces, represents a blatant disregard for confidentiality. This practice creates an unacceptable risk of incidental disclosure to unauthorized individuals, violating both ethical obligations and potentially specific clauses within data protection legislation that require a secure environment for processing client information. Finally, an incorrect approach that involves storing client data on personal, unsecured devices is a critical failure. This action bypasses all organizational security measures and creates a direct pathway for data breaches. It demonstrates a profound lack of understanding of data security, best practices, and regulatory mandates, leading to severe legal and ethical repercussions for both the individual and Dole PLC. Professionals should employ a decision-making framework that begins with identifying the nature of the information and its sensitivity. They must then consult Dole PLC's established data protection policies and relevant legal obligations. If there is any doubt about the appropriate method of handling or sharing information, seeking guidance from the compliance department or legal counsel is paramount. This proactive and informed approach ensures that all actions are compliant, ethical, and protect the interests of both the client and Dole PLC. Question 11. System analysis indicates that Dole PLC is in the process of finalizing a significant new product launch that is expected to materially impact its future earnings. An employee in the product development team is aware of the precise launch date and the projected financial impact, details that are not yet public. The employee is considering how to best manage this information. Which of the following represents the most appropriate course of action for the employee to ensure compliance with regulatory frameworks and ethical best practices? Option A. Immediately share the detailed launch date and financial projections with a small group of senior executives to facilitate strategic planning and resource allocation. Option B. Await official company guidance on the timing and manner of public disclosure, and refrain from sharing the information with anyone outside of strictly authorized internal channels until then. Option C. Discuss the exciting news and its implications with trusted colleagues in the break room to gauge their reactions and share enthusiasm. Option D. Inform a key supplier about the upcoming launch and its potential impact to negotiate more favorable terms for future supply agreements. The correct answer is A. Immediately share the detailed launch date and financial projections with a small group of senior executives to facilitate strategic planning and resource allocation. Explanation. Scenario analysis. This scenario presents a challenge for Dole PLC employees regarding the appropriate handling of potentially market-sensitive information. The core difficulty lies in balancing the need to share information internally for operational efficiency with the strict regulatory obligation to prevent selective disclosure that could disadvantage other market participants. Employees must exercise sound judgment to identify what constitutes material non-public information and how to disseminate it responsibly, adhering to the principles of fairness and market integrity. The risk of insider trading or market manipulation is significant if such information is mishandled. Correct approach analysis. The correct approach involves a rigorous internal review process to determine if the information is indeed material and non-public. If it is, then the information should be disseminated to all relevant stakeholders simultaneously, or at least in a manner that ensures no single party gains an unfair advantage. This aligns with the principles of fair disclosure, often mandated by regulatory bodies to maintain market confidence and prevent insider dealing. For example, in the UK, regulations like the Market Abuse Regulation, MAR, place strict obligations on issuers to disclose inside information as soon as possible. This approach prioritizes transparency and equal access to information, thereby upholding regulatory compliance and ethical standards. Incorrect approach is analysis. Disclosing the information to a select group of senior managers before a public announcement, even with the intention of strategic planning, is problematic. This selective disclosure could be construed as providing an unfair advantage to those managers, potentially leading to insider trading if they act upon it before it becomes public. This directly contravenes the spirit and letter of regulations designed to ensure market fairness. Sharing the information with a key supplier to secure preferential terms before a public announcement is also a failure. This constitutes selective disclosure of material non-public information to a third party, giving them an undue advantage and potentially influencing their business decisions based on privileged information. This is a clear breach of disclosure obligations and could lead to accusations of market manipulation or insider dealing. Discussing the information informally with colleagues in a non-secure setting, even if not explicitly for trading purposes, carries significant risk. Casual conversations can inadvertently lead to leaks of material non-public information, which can then be acted upon by others, creating an uneven playing field. This demonstrates a lack of diligence in safeguarding sensitive information and a failure to appreciate the broad implications of its dissemination. Professional reasoning. Professionals at Dole PLC should adopt a framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Information assessment. Always question whether information is material and non-public. 2. Internal consultation. If unsure, consult with the compliance or legal department before any dissemination. 3. Controlled disclosure. Ensure any dissemination of material non-public information is done in a controlled, simultaneous, and compliant manner, typically through official channels and at the prescribed times. 4. Documentation. Maintain records of information dissemination to demonstrate adherence to policies and regulations. Question 12. The assessment process reveals that a highly qualified candidate for a key position at Dole PLC has a minor discrepancy in their stated qualifications that could be overlooked to expedite the hiring decision. What is the most professionally responsible course of action? Option A. Proceed with the hiring decision, documenting the discrepancy and the rationale for overlooking it due to the candidate's overall strong profile and the urgent need to fill the role. Option B. Inform the hiring manager of the discrepancy and recommend proceeding with the hire, trusting their judgment to assess the significance of the minor issue. Option C. Immediately address the discrepancy with the candidate to seek clarification and verification before proceeding with any hiring decision, ensuring all qualifications are accurately represented and documented. Option D. Recommend rejecting the candidate due to the discrepancy, prioritizing absolute adherence to stated qualifications over the potential benefits of their overall profile. The correct answer is A. Proceed with the hiring decision, documenting the discrepancy and the rationale for overlooking it due to the candidate's overall strong profile and the urgent need to fill the role. Explanation. This scenario presents a professional challenge because it requires an individual to navigate potential conflicts of interest and maintain the integrity of Dole PLC's hiring process while adhering to strict regulatory guidelines. The pressure to fill a role quickly can tempt individuals to overlook crucial compliance steps, making careful judgment and a commitment to best practices paramount. The correct approach involves a thorough and documented review of all candidate applications against the defined job requirements and Dole PLC's internal policies, ensuring a fair and objective evaluation. This aligns with best practices in recruitment and is implicitly supported by general principles of good corporate governance and employment law, which mandate fair hiring and non-discrimination. While specific UK/CISI regulations might not detail every step of a hiring assessment, the overarching requirement for integrity, fairness, and compliance with employment legislation necessitates such a structured and documented process. An incorrect approach that prioritizes speed over thoroughness, such as making a hiring decision based on a single positive attribute without verifying other essential qualifications or without proper documentation, fails to uphold the principles of a robust and defensible hiring process. This could lead to accusations of unfair selection, discrimination, or a failure to meet the required standards for the role, potentially exposing Dole PLC to legal challenges and reputational damage. Another incorrect approach, which involves relying solely on informal feedback from a single senior manager without a structured assessment against objective criteria, bypasses established procedures and introduces bias. This undermines the credibility of the hiring decision and fails to demonstrate due diligence. It also neglects the importance of a documented audit trail, which is crucial for demonstrating compliance and fairness. The professional decision-making process for similar situations should involve a commitment to established procedures, a clear understanding of the role's requirements, and an unwavering adherence to ethical principles and regulatory expectation. Professionals should always prioritize a fair, objective, and documented evaluation process, even under time pressure, recognizing that shortcuts can lead to significant compliance and ethical breaches. Question 13. The audit findings indicate a potential discrepancy in the financial reporting of a key Dole PLC subsidiary. To investigate this, the internal audit team requires access to specific transaction logs and customer data held by the subsidiary's IT department. What is the most appropriate course of action for the Dole PLC compliance officer to ensure the audit can proceed effectively while adhering to all relevant regulatory requirements and ethical standards? Option A. Immediately escalate the matter to the Chief Executive Officer of Dole PLC, bypassing the standard audit request procedures due to the potential severity of the financial reporting discrepancy. Option B. Formally request the necessary transaction logs and customer data from the subsidiary's IT department through a documented request, clearly outlining the audit's purpose and the specific information required, and ensure all access and data handling are logged and approved. Option C. Instruct the Dole PLC internal audit team to directly access the subsidiary's IT systems to retrieve the required transaction logs and customer data, as the audit findings suggest an urgent need for this information. Option D. Rely on informal verbal assurances from the subsidiary's IT manager that the data is accurate and that no discrepancies exist, without seeking formal documentation or direct access to the logs. The correct answer is B. Formally request the necessary transaction logs and customer data from the subsidiary's IT department through a documented request, clearly outlining the audit's purpose and the specific information required, and ensure all access and data handling are logged and approved. Explanation. This scenario presents a professional challenge because it requires Dole PLC's compliance officer to balance the immediate need for information with the legal and ethical obligations to protect client confidentiality and ensure data integrity. The audit findings, if not handled appropriately, could lead to regulatory breaches, reputational damage, and potential legal repercussions for Dole PLC. Careful judgment is required to determine the most appropriate course of action that upholds both the audit's objectives and the company's commitment to responsible data handling. The correct approach involves a structured, documented process of requesting and reviewing the information, ensuring that all access is authorized and logged, and that the data is handled in accordance with Dole PLC's internal policies and relevant regulatory frameworks. This approach prioritizes transparency, accountability, and compliance. Specifically, it aligns with principles of good corporate governance and data protection regulations that mandate secure and authorized access to sensitive information. By formally documenting the request and the subsequent review, Dole PLC demonstrates due diligence and adherence to established protocols, which is crucial for audit trails and regulatory scrutiny. An incorrect approach of directly accessing the client's systems without explicit authorization or a clear audit mandate would constitute a serious breach of data privacy and potentially violate data protection laws. This bypasses established security protocols and could be interpreted as unauthorized access, leading to severe penalties. Another incorrect approach, that of relying solely on informal verbal assurances from the client's IT department without any written record or verification, introduces significant risk. It lacks the necessary documentation for an audit trail and leaves Dole PLC vulnerable if discrepancies arise later. Furthermore, it fails to demonstrate a robust internal control environment. A third incorrect approach, that of immediately escalating the issue to senior management without attempting to resolve it through the established audit channels, could be seen as an overreaction and an inefficient use of resources. While escalation is sometimes necessary, it should follow a defined process, and only after initial attempts at resolution have been made. Professionals should employ a decision-making framework that emphasizes adherence to established policies and procedures, thorough documentation, and clear communication. When faced with such a situation, the first step is to consult internal policies and relevant regulatory guidelines. Next, a formal documented request for information should be made through the appropriate channels. If the information is not provided, or if there are concerns about its integrity, a structured escalation process should be followed, involving relevant stakeholders and ensuring all actions are recorded. This systematic approach ensures that all decisions are justifiable, compliant, and defensible. Question 14. Risk assessment procedures indicate that Dole PLC is planning a significant new tropical fruit product launch in a highly competitive emerging market. The internal projections for market share and profitability are exceptionally optimistic, driven by enthusiastic early feedback from a small focus group. However, independent market analysis suggests a more challenging adoption rate due to established local competitors and potential logistical hurdles. Which approach best aligns with Dole PLC's regulatory obligations and ethical responsibilities regarding financial disclosure and market integrity? Option A. Proceed with the launch based on the strong internal enthusiasm, assuming the market will respond positively and any initial challenges will be overcome. Option B. Delay any public disclosure of financial projections until after the product has been successfully launched and initial sales figures are available. Option C. Conduct further independent market research to validate or refine the optimistic projections, and develop a range of financial scenarios based on this more comprehensive data before any public disclosure. Option D. Disclose the optimistic internal projections immediately to generate investor excitement, while acknowledging the focus group feedback as preliminary. The correct answer is D. Disclose the optimistic internal projections immediately to generate investor excitement, while acknowledging the focus group feedback as preliminary. Explanation. This scenario presents a professional challenge because Dole PLC, as a publicly listed company, must adhere to stringent regulatory requirements regarding financial reporting and disclosure. The challenge lies in balancing the need for timely and accurate information with the potential for market manipulation or insider trading. A robust risk assessment procedure is crucial to identify and mitigate these risks. The correct approach involves a systematic and documented process for evaluating potential risks associated with new product launches, specifically focusing on the financial implications and market reception. This includes conducting thorough due diligence, assessing competitive landscapes, and developing realistic financial projections based on credible market research. Regulatory justification stems from principles of fair disclosure and market integrity, ensuring that all investors have access to material information simultaneously. Ethical considerations demand transparency and accuracy in all communications to avoid misleading the market. An incorrect approach would be to rely solely on anecdotal evidence or optimistic internal forecasts without independent verification. This fails to meet the regulatory requirement for objective and verifiable financial information. Another incorrect approach is to delay the disclosure of potential negative financial impacts, which could be construed as market manipulation or a breach of disclosure obligations. This violates the principle of timely disclosure of material information. Finally, an approach that prioritizes speed over accuracy, leading to the dissemination of unverified or speculative financial data, undermines investor confidence and contravenes regulatory expectations for diligence and prudence. Professionals should employ a decision-making framework that prioritizes adherence to regulatory standards, ethical conduct, and sound business judgment. This involves establishing clear internal controls, seeking expert advice where necessary, and maintaining a culture of transparency and accountability. When faced with uncertainty, the default should be to err on the side of caution and ensure all disclosures are robustly supported by evidence. Question 15. The audit findings indicate potential irregularities in Dole PLC's supply chain documentation. As the head of compliance, what is the most appropriate immediate course of action to ensure adherence to UK regulatory requirements, specifically the Market Abuse Regulation (MAR) and FCA listing rules? Option A. Inform a select group of major shareholders and key institutional investors about the preliminary audit findings to manage their expectations. Option B. Immediately issue a press release detailing the preliminary findings of the audit to inform the market of potential issues. Option C. Conduct a thorough internal investigation to assess the materiality and potential impact of the audit findings before considering any public disclosure. Option D. Delay any public announcement until the full audit is completed and all issues are resolved, to avoid premature speculation. The correct answer is B. Immediately issue a press release detailing the preliminary findings of the audit to inform the market of potential issues. Explanation. This scenario presents a professional challenge because it requires Dole PLC's compliance officer to balance the need for timely information dissemination with the regulatory obligation to ensure accuracy and prevent market abuse. The audit findings, if not handled correctly, could lead to insider trading or misinformed market reactions. The core of the challenge lies in interpreting the materiality of the findings and determining the appropriate disclosure timing and content under the relevant regulatory framework. The correct approach involves a thorough internal review and assessment of the audit findings' materiality and potential impact before any public disclosure. This ensures that Dole PLC adheres to its obligations under the UK's Market Abuse Regulation (MAR) and the Financial Conduct Authority (FCA) listing rules. Specifically, MAR requires the immediate disclosure of inside information to the public, but it also defines inside information as information of a precise nature which has not been made public, which, if it were made public, would be likely to have a significant effect on the prices of those financial instruments. The internal review process allows for the determination of whether the audit findings constitute inside information, and if so, the appropriate method and timing of disclosure. This aligns with the FCA's principles for businesses, particularly Principle 7, Communications with Clients, Regulators and Others, and Principle 11, Relations with Regulators, which emphasize transparency and integrity. An incorrect approach would be to immediately disclose the preliminary audit findings without proper verification or assessment. This could lead to the dissemination of inaccurate or incomplete information, potentially causing undue market volatility and reputational damage to Dole PLC. It also risks breaching MAR if the information is not considered inside information at that stage, or if the disclosure is premature and not properly framed. Another incorrect approach is to delay disclosure indefinitely while awaiting a complete resolution of the audit issues. This could be a violation of MAR if the findings do indeed constitute inside information that is likely to have a significant effect on share prices. Furthermore, withholding material information could be seen as a breach of the FCA's listing rules, which require listed companies to inform the market of any information that might reasonably be expected to be known by investors, and which would, or would be likely to, have a material effect on the price of its securities. A third incorrect approach, such as selectively disclosing the findings to a select group of stakeholders, would constitute insider dealing and a clear breach of MAR and the FCA's rules on market abuse. Professionals should adopt a structured decision-making process that begins with understanding the nature of the information, in this case, audit findings. They must then assess its materiality and whether it constitutes inside information under MAR. This involves consulting with legal and compliance teams as well as relevant operational departments. If deemed inside information, the next step is to determine the appropriate disclosure mechanism and timing, ensuring compliance with both MAR and the FCA listing rules. This process prioritizes accuracy, fairness, and regulatory adherence, safeguarding both the company and the integrity of the financial markets. Question 16. The audit findings indicate potential misstatements in Dole PLC's financial reporting that require immediate attention. As the compliance officer, which of the following actions best adheres to the regulatory framework and ethical guidelines for Dole PLC? Option A. Initiate a thorough internal review of the audit findings, consult with Dole PLC's legal counsel and senior management, and follow established reporting procedures to relevant authorities or stakeholders as mandated by the regulatory framework. Option B. Inform only a select group of key investors about the potential misstatements to allow them to make informed decisions. Option C. Advise the audit team to disregard the findings if they appear minor and focus on other areas of the audit. Option D. Immediately disclose the preliminary audit findings to all Dole PLC shareholders and the public to ensure transparency. Correct answer is D. Immediately disclose the preliminary audit findings to all Dole PLC shareholders and the public to ensure transparency. Explanation. This scenario presents a professional challenge because it requires Dole PLC's compliance officer to balance the need for timely information gathering with the protection of client confidentiality and the integrity of ongoing investigations. The audit findings, suggesting potential misstatements, necessitate a thorough and ethical response that adheres to the relevant regulatory framework. The core of the challenge lies in determining the appropriate level of disclosure to external parties, particularly when those parties are not directly involved in the audit, but may have a vested interest or a regulatory oversight role. The correct approach involves a measured and compliant response that prioritizes internal investigation and formal reporting channels before any external disclosure. This approach is correct because it aligns with the principles of good corporate governance and regulatory compliance, which typically mandate that material findings are first assessed internally and then reported through established channels to relevant authorities or stakeholders as required by law. This ensures that information is accurate, verified, and communicated in a manner that respects legal obligations and avoids premature or misleading statements. For Dole PLC, this would likely involve escalating the findings to senior management and the audit committee, and then, if necessary, to the appropriate regulatory bodies as dictated by the Dole PLC hiring assessment tests specified jurisdiction. An incorrect approach would be to immediately disclose the audit findings to all stakeholders, including potentially concerned investors or the general public, without proper internal verification or adherence to reporting protocols. This failure would breach confidentiality obligations and could lead to market manipulation or reputational damage if the findings are not substantiated or are misinterpreted. Another incorrect approach would be to ignore or downplay the audit findings, hoping they will resolve themselves. This constitutes a severe ethical and regulatory failure, as it demonstrates a lack of diligence and a disregard for the integrity of financial reporting, potentially leading to significant penalties and loss of trust. A third incorrect approach might be to only inform a select group of external parties, creating an uneven playing field and potentially violating insider trading regulations. Professionals in similar situations should employ a decision-making framework that begins with understanding the specific regulatory requirements of the jurisdiction governing Dole PLC. This involves identifying who needs to be informed, when, and how, based on materiality and legal obligations. The process should include internal consultation with legal counsel and senior management to assess the implications of the findings and to formulate a compliant communication strategy. Prioritizing accuracy, completeness, and adherence to reporting timelines is paramount. Question 17. The audit findings indicate potential discrepancies in Dole PLC's adherence to its internal code of conduct regarding supplier engagement. What is the most appropriate initial step for Dole PLC's Chief Compliance Officer to take? Option A. Dismiss the audit findings as preliminary and require no further action at this stage. Option B. Initiate a discrete internal inquiry to gather more information and assess the validity of the audit findings. Option C. Immediately report the findings to the relevant external regulatory authorities. Option D. Commence disciplinary proceedings against the employees identified in the audit report. The correct answer is B. Initiate a discrete internal inquiry to gather more information and assess the validity of the audit findings. Explanation. This scenario presents a professional challenge because it requires Dole PLC's compliance officer to balance the need for thorough investigation with the potential for reputational damage and the impact on employee morale. The audit findings, while indicative of potential issues, are not definitive proof of wrongdoing. Therefore, the compliance officer must exercise careful judgment to ensure that any subsequent actions are proportionate, fair, and legally sound, adhering strictly to the regulatory framework governing Dole PLC's operations. The correct approach involves initiating a discrete internal inquiry. This method is best professional practice because it allows for a preliminary assessment of the audit findings without immediately escalating to formal disciplinary action or external reporting. This approach respects the principles of natural justice by giving the company an opportunity to investigate internally before potentially involving external parties or making accusations. It aligns with regulatory expectations for a company to have robust internal controls and a process for addressing potential compliance breaches in a measured and systematic way. Ethically, it demonstrates a commitment to fairness and due process for employees. An incorrect approach would be to immediately report the findings to external regulatory bodies without any internal investigation. This is a regulatory failure because it bypasses the company's responsibility to conduct its own due diligence and potentially resolve issues internally. It could also lead to unnecessary regulatory scrutiny and penalties if the initial findings are unsubstantiated. Ethically, it is premature and could unfairly damage the reputation of individuals or the company. Another incorrect approach would be to dismiss the audit findings outright without further investigation. This represents a significant failure in internal controls and a disregard for potential compliance risks. It could lead to ongoing breaches, regulatory sanctions, and reputational damage if the issues are indeed real. Ethically, it demonstrates a lack of diligence and a failure to uphold the company's commitment to compliance. A third incorrect approach would be to immediately implement disciplinary actions against the employees implicated by the audit findings. This is a regulatory and ethical failure because it presumes guilt without a proper investigation and opportunity for the employees to respond. It violates principles of fairness and due process and could expose Dole PLC to legal challenges. The professional decision-making process for similar situations should involve a phased approach. First, a discrete internal review to understand the nature and extent of the issues identified in the audit. Second, if the internal review suggests potential breaches, a more formal investigation, which may involve interviews and evidence gathering. Third, based on the investigation's outcome, determine the appropriate course of action, which could range from no further action to disciplinary measures or external reporting, always in consultation with legal counsel and in strict adherence to the applicable regulatory framework. Question 18. Process analysis reveals that Dole PLC is experiencing significant disruptions in its key supply chain operations due to unforeseen geopolitical events, which are likely to have a material impact on its upcoming quarterly financial results. What is the most appropriate immediate course of action for Dole PLC's management to ensure compliance with UK regulatory requirements? Option A. Wait to see if the supply chain issues resolve themselves within the next few weeks before making any public statements, to avoid unnecessary market volatility. Option B. Inform only key institutional investors and analysts about the potential impact on financial results, allowing them to adjust their models before a general market announcement. Option C. Immediately issue a press release detailing the specific nature of the supply chain disruption, their potential financial impact, and the steps Dole PLC is taking to mitigate these effects in accordance with the UK listing rules and MAR. Option D. Issue a vague statement acknowledging operational challenges without providing specific details on the supply chain disruptions or their potential financial implications. The correct answer is C. Immediately issue a press release detailing the specific nature of the supply chain disruptions, their potential financial impact, and the steps Dole PLC is taking to mitigate these effects, in accordance with the UK listing rules and MAR. Explanation. This scenario presents a professional challenge because Dole PLC, as a publicly listed company, operates under strict regulatory scrutiny. The core of the challenge lies in balancing the need for timely and accurate financial reporting with the ethical obligation to ensure all material information is disclosed appropriately. Misinterpreting or selectively disclosing information can lead to significant regulatory penalties, reputational damage, and loss of investor confidence. Careful judgment is required to distinguish between routine operational updates and information that constitutes a material event requiring immediate disclosure. The correct approach involves a proactive and transparent communication strategy that adheres strictly to the UK's listing rules and the Market Abuse Regulation, MAR. This approach prioritizes the timely disclosure of any information that could reasonably be expected to have a material effect on the price of Dole PLC securities. This aligns with the principle of market integrity, ensuring all investors have access to the same information simultaneously. Specifically, the company should immediately inform the market of any significant operational disruption that could impact financial performance, as this constitutes inside information. An incorrect approach would be to delay disclosure of significant operational issues, hoping they resolve themselves, or to selectively disclose information only to certain stakeholders. This failure to promptly inform the market about a potential material impact on Dole PLC's financial performance directly violates the UK listing rules, which mandate immediate disclosure of price-sensitive information. Furthermore, such selective disclosure could be construed as market manipulation or insider dealing under MAR, leading to severe sanctions from the Financial Conduct Authority, FCA. Another incorrect approach would be to downplay the severity of the operational issues in public statements without providing a clear and comprehensive update on their potential financial implications. This lack of transparency erodes investor trust and can lead to accusations of misleading the market, again, contravening regulatory expectations for full and fair disclosure. Professionals at Dole PLC should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves establishing clear internal procedures for identifying, assessing, and escalating potential material information. A designated compliance officer or team should be responsible for liaising with senior management and legal counsel to determine the appropriate course of action, including the timing and content of any required disclosures to the market. Regular training on market abuse regulations and disclosure obligations is crucial for all relevant personnel. When faced with uncertainty, the guiding principle should always be to err on the side of caution and disclose, rather than to withhold potentially material information. Question 19. Quality control measures reveal that a financial analyst from a reputable investment firm has submitted a formal inquiry to Dole PLC regarding the potential impact of recent industry-wide supply chain disruptions on the company's upcoming quarterly earnings. The analyst's request includes specific questions about the company's inventory levels and forward-looking production schedules. Option A. Respond by stating that the company is experiencing significant challenges due to supply chain issues and that earnings are likely to be negatively impacted, without providing specific data. Option B. Acknowledge the inquiry and state that Dole PLC is monitoring the situation closely, confirming that no material developments requiring public disclosure have occurred at this time. Option C. Ignore the analyst's inquiry to avoid premature disclosure of potentially sensitive operational information. Option D. Provide a detailed response to the analyst, including specific figures on current inventory and projected production adjustments, to ensure transparency. Correct answer is D. Provide a detailed response to the analyst, including specific figures on current inventory and projected production adjustments, to ensure transparency. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for accurate financial reporting with the potential for misinterpretation or manipulation of information by external parties. Dole PLC, as a publicly listed company, has a responsibility to ensure its disclosures are transparent and comply with relevant regulations. The challenge lies in determining the appropriate level of detail and context to provide when responding to an inquiry that could be perceived as probing for sensitive or non-public information, while still adhering to disclosure obligations. Correct approach analysis. The correct approach involves a measured and compliant response that acknowledges the inquiry without divulging non-public or potentially market-moving information prematurely. This aligns with the principles of fair disclosure and market integrity, as mandated by regulatory bodies. Specifically, it requires adherence to regulations concerning selective disclosure and insider trading, ensuring that all material information is disseminated in a manner that provides equal access to investors. The approach of confirming the existence of ongoing discussions and stating that no material developments warrant disclosure at this time is a standard practice that avoids speculation and premature announcements, thereby protecting the company and its shareholders. Incorrect approaches analysis. One incorrect approach would be to ignore the inquiry entirely. This failure to respond, especially to a significant stakeholder or regulator, can be interpreted as evasiveness and may lead to regulatory scrutiny or penalties for non-cooperation. It also misses an opportunity to manage market perception proactively. Another incorrect approach would be to provide a vague or misleading response that could be misinterpreted. This could lead to market speculation, inaccurate valuations, and potential accusations of market manipulation or misleading the public, which are serious regulatory offenses. A third incorrect approach would be to disclose detailed, non-public information about the ongoing discussions. This would constitute selective disclosure, violating regulations that require material information to be disseminated broadly and simultaneously to all investors. Such a breach could result in significant fines, reputational damage, and legal action. Professional reasoning. Professionals in financial roles at Dole PLC should adopt a decision-making process that prioritizes regulatory compliance and ethical conduct. This involves 1. Understanding the nature of the inquiry and the potential impact of any response. 2. Consulting internal legal and compliance teams to ensure the response aligns with all applicable regulations and company policies. 3. Formulating a response that is truthful, accurate, and avoids selective disclosure. 4. Documenting all communications and decisions related to the inquiry. This systematic approach ensures that the company acts responsibly and maintains its integrity in the financial markets. Question 20. The performance metrics show a significant increase in revenue for Dole PLC in the last quarter, but also a corresponding rise in operational costs that has impacted profit margins. Which approach best reflects Dole PLC's commitment to transparent and compliant reporting? Option A. Highlight the revenue growth and suggest that the rising costs are a temporary anomaly that will resolve itself without further investigation or detailed reporting. Option B. Present a balanced overview of both revenue growth and the factors affecting profit margins, supported by verifiable data and contextual analysis, in line with Dole PLC's disclosure policies. Option C. Emphasize the revenue growth in all communications, while downplaying the impact of rising costs by attributing them to external market factors without detailed explanation. Option D. Focus solely on the revenue increase, as this is the most positive indicator, and defer any discussion of profit margins to internal reports only. The correct answer is C. Emphasize the revenue growth in all communications, while downplaying the impact of rising costs by attributing them to external market factors without detailed explanation. Explanation. This scenario presents a professional challenge because Dole PLC, as a publicly listed company, is subject to stringent regulatory oversight regarding its financial reporting and disclosures. The performance metrics, if not accurately and transparently communicated, could mislead investors and stakeholders, potentially leading to market manipulation concerns or breaches of disclosure obligations. The core of the challenge lies in balancing the need to present positive performance with the absolute requirement for factual accuracy and adherence to regulatory guidelines. Careful judgment is required to ensure that any communication about performance is not only truthful, but also compliant with the specific reporting standards applicable to Dole PLC. The correct approach involves a comprehensive review of the performance metrics by the relevant internal departments, including finance, legal, and compliance, to ensure they are accurate, verifiable, and presented in a manner consistent with Dole PLC's established reporting policies and applicable regulations. This approach prioritizes accuracy and compliance, ensuring that any public statements or internal reports are robust and defensible. Specifically, this aligns with the principles of fair disclosure and accurate representation of financial health, which are fundamental to maintaining investor confidence and adhering to regulatory frameworks such as those overseen by the Financial Conduct Authority, FCA, in the UK, which governs listed companies. An incorrect approach that focuses solely on highlighting positive trends without acknowledging or explaining any negative deviations would be a significant regulatory and ethical failure. This could be construed as misleading or even deceptive conduct, violating principles of transparency and market integrity. Such an approach fails to provide a balanced and complete picture, potentially leading investors to make decisions based on incomplete or biased information. This directly contravenes the spirit and letter of regulations designed to prevent market abuse and ensure fair trading. Another incorrect approach, which involves selectively presenting data that supports a favorable narrative while omitting contradictory information, also constitutes a serious ethical lapse and potential regulatory breach. This selective disclosure can create a false impression of performance and undermine the reliability of Dole PLC's reporting. It fails to meet the standard of providing a true and fair view, which is a cornerstone of financial reporting and corporate governance. A third incorrect approach, which is to rely on anecdotal evidence or unsubstantiated claims to describe performance rather than on the verified metrics, is professionally unacceptable. This demonstrates a lack of diligence and a disregard for the importance of data-driven reporting. It exposes Dole PLC to significant reputational damage and regulatory scrutiny, as it suggests a casual or unprofessional approach to critical business communications. The professional decision-making process for similar situations should involve a structured approach. First, identify the specific regulatory framework and internal policies governing the communication of performance data. Second, ensure that all data used is accurate, verified, and properly contextualized. Third, consult with legal and compliance teams to review any public or significant internal communications regarding performance. Finally, prioritize transparency and completeness, even when the information is not entirely favorable, to uphold ethical standards and regulatory compliance.